Hey guys, it's your bald Indian here, and today we are going to talk about tapering. What is tapering? Investopedia says tapering is a theoretical reversal of QE, which is quantitative easing, and implemented by central bank to stimulate economic growth. There you go. Hope you like the video. Please drop a like. I'm kidding. Hope they made it that easy to understand. Quantitative easing is a process where central bank injects money into the economy by buying long-term bonds, mortgage-backed securities and assets. It is commonly referred to central bank printing a lot of money and giving it to bank and major corporations. But it is little bit more complex than that. The Plain Beagle channel has explained this complex topic pretty well, and I'll link it in the description below. So one of the main objectives of quantitative easing is to lower the borrowing cost, which will in turn boost the economic activity and quickly increase the domestic money supply. So quantitative easing is usually done when market is at a downturn, for example during 2008 housing market crash and recently during 2020 COVID outbreak. After a certain period of time, as economy shows signs of recovery, central bank would basically stop or slow down this quantitative easing process, which is also called as tapering. So what happens if Fed doesn't taper and continues to print money? Well, in this case, adding more money into circulation makes it easy for people to borrow money at lower interest rate. And as people have access to this easy money, the demand for goods go higher, which in turn drive the prices of the goods, which is also called as inflation. In last few months, you might have seen a steep increase in gas prices, property prices, and groceries. These are some key indicators of inflation. Another potential negative outcome of quantitative easing is that it can devalue the currency. As the interest rates are at their lower level, there is an increased activity of currency outflow out of the country, which in turn lowers the demand of the currency, leading to weaker dollar. This weaker dollar does benefit the export industry as exports become more cheaper, but does drive up the import cost, leading to higher good prices. In past few months, there has been boom in overall employment and wages, which is a direct effect of quantitative easing in short run. However, as and when this bond buying stops, so does bank lending and businesses start to contract. It's a well-known fact that as businesses start to contract, they reduce the number of people that they can hire. As a result, people get fired and therefore employment level plummets in long run. This abundance of money leading to higher wages, higher profit and lower interest rate does find its way to the markets, where people throw money at speculative assets, thus creating an asset bubble. Well, what happens if Fed tapers early? Well, in this case, tapering leads to deflation, pulling out more money out of the system, making cost of living more affordable, but increase in unemployment. When money supply is limited, banks tend to have more restrictions on who that they can lend this money to and choose those that can offer higher interest rate. This selective borrowing can lead to higher competition that can send interest rates skyrocketing higher. In 2008, after the global financial crisis, Fed launched 3 rounds of quantitative easing starting from December 2008 to October 2014. In round 1, Fed bought $1.2 trillion worth of mortgage-backed securities and $700 billion of treasury bonds. In round 2, they bought more $600 billion of treasury securities, keeping that would maintain Fed's holding at $2 trillion level. In round 3, Fed agreed to buy more $40 billion worth of mortgage-backed securities, adding a total of $85 billion of liquidity a month. In total, Fed bought $790 billion of treasury bonds and $823 billion of mortgage-backed securities in round 3. During this time, Fed's balance sheet almost quadrupled from $800 billion from beginning of the year to $4.4 trillion by the end of October 2014. In congressional testimony on May 21, 2013, Fed Chair Ben Bernanke did signal that tapering was around the corner. He said, "If we see continued improvement and we have confidence that it is going to be sustained, then we could, in the next few meetings, take a step down in our pace of purchases." This was based on 3 economic targets being met. Unemployment rate at 7%, GDP growth was between 2% to 3%, and the core inflation rate hadn't exceeded 2%. After this announcement by Ben Bernanke, market was caught by surprise and there was a sudden increase in interest rate, which is also called as taper tantrum. The Dow Jones Industrial Average did sell off by 0.5%, by the end of the day, and all 10 S&P 500 sectors did see a decline. This was just a small blip in the market. Eventually, markets did recover and ended the year 30% in green. In 2020, after COVID outbreak, Fed did something unusual, which was unlimited quantitative easing. For most of the year and a half, Fed was buying at least $120 billion worth of bonds on monthly basis, providing unprecedented support to the financial market. This bond buying process has added almost $4 trillion to Fed's balance sheet, totaling to $8.5 trillion. This purchases has helped to keep interest rate low at the historical levels, provided support to markets that were malfunctioning badly at the beginning of the pandemic crisis, and also coincided with the powerful run in the stock market. So when is Fed looking to taper? On September 22nd, after FOMC meeting, Fed did release the meeting minutes, which stated that 9 out of 18 FOMC members are expecting a rate hike between 0.5 to 0.75% in 2022 to 1% in 2023, 2% in 2024, and 2.5% in long run. After the recent release of CPI data in October, there are speculations that Fed might start tapering sooner, as soon as in November of this year. Fed does release this FOMC meeting minutes and dot plot charts on a public website. I'll link it in the description below. Well, that is it for today, guys. Hope you liked the video. Please let me know what you think of this whole scenario in the comment section below, and please subscribe for the next video.